Welcome back, everybody, to Chapter 7, Accounting for Receivables. And in this chapter, we're going to take a look at how receivables occur, but also how we compute its maturity date and recording that, and how receivables get converted to cash before maturity. You have a little bit of an introduction to that we've gone through. But in this chapter, we're going to look at the direct write-off method and see why it is not acceptable under generally accepted accounting principles, and where the allowance method is. So, as usual, we'll take a look at some adjustments for that, and also at the end, we'll take a look at our analytical metrics. All right. How do these receivables occur? Well, a company maintains a separate account for each customer, and that tracks how much that customer has already paid and still owes. Very important to track that aging. Some of our customers are not as honorable at paying us on time, so we have to stay on those customers routinely to get them to pay us on time. All right, so here's an example. We're going to make a sale on credit here, and on July 1, TechCom made this credit sale of $950 to CompStore, and they also collected another receivable from another company, RDA Electronics, from a prior credit sale. So here, if we look, you're going to see that this is going to be in an account receivable subsidiary ledger, meaning that it's to CompStore here. And this one here is to a subsidiary receivables ledger as well. Those subsidiary receivables ledger then roll into the aggregate accounts receivable general ledger account. Okay, so this is pretty familiar to you, I hope, by now. Here we're going to debit accounts receivable and credit sales for $950. And then when we collect it, we're going to debit cash because we're getting cash from our customer here and reducing that accounts receivable as that customer has now honored us by paying us. Note this little footnote too. Here, they're eliminating the cost of sales and the debit to cost of sales and the credit to inventory, so we can just focus on receivables here. And also, no sales returns and allowances are expected here. So they keep it simple for you. Now, here's our accounts receivable ledger for CompuStore, and we're going to take a look at that. Here is our subsidiary receivable ledgers for RDA Electronics and CompStore. And as you can see, we've reduced the amount here to RDA by crediting accounts receivable, and we've increased accounts receivable here to CompStore. Those go into the schedule of accounts receivable that we track. And we have a total now of $3230 in total accounts receivable, which tie, of course, to the general ledger balance on July 1. So, now, if we make a sale on a bank card, there's a fee associated with that transaction. So, here, TechCom has a $100 credit card sale with a 4% fee, and it's $96 in cash is going to be received immediately upon deposit. So how we would record that is we would debit our cash for $96. We have an expense, credit card expense, for $4 here, and we credit the entire sale of $100 as shown here. Now, the direct write-off method. If you were just starting in accounting, you would probably think this would be the way you would write off a bad debt. We would simply, if we debited accounts receivable and credited sales, we would probably debit sales and credit accounts receivable to write that off. But we keep it in a separate account, and I'll show you that in a second. So there's two methods of accounting for bad debts here. One is the direct write-off method, and the other is the allowance method. So let's take a look at that. And uncollectible accounts are referred to as bad debts. So TechCom determines on January 23rd that it cannot collect $520 owed to it by its customer, J. Kent. Okay, so what is it going to do? It's going to debit an account called Bad Debts Expense and credit accounts receivable to J. Kent. That's the direct write-off method. And notice that the specific customer, again, J. Kent, is in that accounts receivable subsidiary ledger, as indicated here. Okay. So as you see, we don't debit sales. We debit bad debts expense. Okay. Now, this again is the direct write-off method, and that's not consistent with generally accepted accounting principles. Now, if, for example, J. Kent gets a stroke of responsibility here and pays us back, we have to reverse that entry that we just did by debiting accounts receivable and crediting bad debts expense to reinstate that receivable. Now when we collect it, we'll debit cash and credit accounts receivable to record the full payment of that account. Okay, and as this slide indicates, the expense recognition principle does require expenses to be reported in the same accounting period as the sales they helped to produce. And our materiality constraint permits direct write-off method if the results, approximate results using the allowance method, if they approximate that result, which is never the case, I might add, but nevertheless. The direct write-off method usually does not best match sales and expenses. Let's take a look. Now, if we do the allowance method, which every company of any size does, we are going to estimate at the end of each period the total bad debts to expected to be realized from that period's sales. The advantages are that it records the estimated, I keep emphasizing estimated, bad debts expense in the period when the related sales are recorded. So it reports the accounts receivable on the balance sheet at the estimated amount of cash to be collected. So how does that work? All right. We're going to take a look at the allowance method here, and TechCom has credit sales of $300,000 during its first year, and at the end of the first year, $20,000 of credit sales remain uncollected. Based on the experience of similar businesses, TechCom thinks that $1,500 of that's going to be uncollectible. They don't know that. That's an estimate, I keep emphasizing. So at the end of the year, we're going to debit bad debts expense here on the income statement. That's going to reduce the income in that period, even though it's an estimate, and credit the allowance for doubtful accounts on the balance sheet. Okay, so in T account format, you see what has happened here and here. Okay, the balance sheet presentation of that is interesting because the allowance for doubtful accounts is a contra asset account. Now, TechCom had this $20,000 of accounts receivable. We still have that on the balance sheet, but we have now an allowance for doubtful accounts, which we're going to subtract here to get to our net receivables, net realizable value of our receivables. Sometimes companies will just show, in this case, the $18,500 as the net accounts receivable and not show, call it the gross accounts receivable. Okay, so now let's determine, in this case, J. Kent account is uncollectible. So if that's the case, we're going to write it off against the allowance. We don't debit a bad debt expense here. We've already recorded the bad debt expense when we estimated it. So here, we're going to reduce that allowance for doubtful accounts by $520, and we're going to reduce accounts receivable subsidiary ledger to J. Kent for $520. And you see how this looks in T account format now. Now, the interesting thing about this is that when we write off a bad debt using the allowance method, you can see that the realizable value of accounts receivable are unchanged. Here we started with $20,000. We had an allowance of $1,500, and that gave us a net accounts receivable of $18,500. But after the write-off, the $20,000 goes down to $19,480. The $1,500 goes down to $980, and the realizable value remains the same at $18,500. An important concept. Now, to help restore credit standing, now a customer sometimes will decide to pay us after it's been written off. So here, all the way into March now, J. Kent does just that. So we reverse what we did a second ago by debiting the accounts receivable to J. Kent and crediting the allowance for doubtful accounts, which puts this receivable back up. Now we collect it. And when we collect it, we're going to debit cash and credit accounts receivable to J. Kent to record full payment. So now we're going to take a look at estimating uncollectible accounts based on sales and then based on accounts receivable. We do that differently. So we have two methods here. One is the percent of sales method, and two, the balance sheet methods. We have two methods under that balance sheet method. One is a percent of accounts receivable, and then number two is aging of accounts receivable. I would say that I have always used the aging of accounts receivable method, for I find it to be more accurate that way. Okay, so if I were to use a percent of sales method, I'm going to take my bad debts expense and compute it like this. We take our bad debt percent, multiply it by our current period sales, and that gives us our estimated bad debt expense. Just that simple. And I think that's a good place for us to stop for right now, this video. And when we come back, we'll take a look at this example. Until then, bye for now.